Over the next 3-ish months to the end of the year, not too worried about it. By the end of 2022, yes. I think that there might be a very stiff correction coming down the line.
Thanks for joining us for part 2 of our interview with macro research analyst Jim Bianco. If you haven't yet watched part 1 of our discussion with Jim, in which he explains why contagion from a growing number of directions is throwing a monkey wrench into the gears of the global economy, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Jim and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, please don't forget to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. Believe it or not, these tiny steps really do help us out. Okay, let's get started watching part 2 of our interview with Jim Bianco. So Jim, I gotta ask this. It's a dual question, but it's a short one. One is this head-scratching dynamic that you just talked about, where everything is, economy is slowing, but prices are rising, and yet people who don't have jobs are stepping up and being willing to pay. Do you see that as transitory? Right. In other words, in my mind, I don't see how that can last for very long, and it just might be because people still have some cushion left over from all the stimulus that's been given to date. So one, is it transitory? And B, and I'm trying to think of a respectful way to ask this question. So I'm just going to ask it directly with as much respect as I can muster in my head. But is the American consumer just a freaking idiot?
No, I don't think they're an idiot. I'll start with that that one first. I'll come back to, I think, we just cannot comprehend what a sitting at home for a year did to change everybody's psyche, is really what it was. If you want to call them shell-shocked, if you want to call them, blindsided or something like that, you can use those words as well too. But I think that, like I said, like the Great Depression, I think their attitudes have just changed. And there's just been a rethink. Look, I found the same thing as well too, because I work with a lot of financial services companies, and I can tell you a lot of these companies that had people that made well into 6 figures, virtually every company I talk to across the board. Okay, it's after Labor Day. It's time to get everybody back in the office. And these people that make all this good money and all these decent positions, no, I quit. I don't want to go back to the office. I just quit. That was unthinkable before the pandemic, that somebody would actually consider doing something like that. And from the stock boy at the local big box retailer all the way up the line, you've got that rethink. So I don't think that they're being idiots. I just think that they've reassessed. Maybe they've had a midlife crisis. Maybe they've seen something else, by sitting at home for a year or something that we don't comprehend. And again, you're right. Are they just sitting around looking at their bank account and judging, how many more weeks or months they can go without work? Boy, that would have been the ultimate of irresponsibility in 2019. Oh, I don't need to go find a job now. I can hang out for 3 more months. I got 3 more months worth of rent payments before I run out of money, and then I'll go look for a job. No one thought that way. We weren't wired like that prior to the pandemic, but we are now. And so I think we really got to start to understand how things have changed. And what I'm leading up to is maybe our perceptions about the economy and what a good economy and what a bad economy is changing as well too. And we're just not able to get our head around it. It's the difficult one. I guess what I'm trying to say is I'm as stunned as you are that people are behaving this way. And yet I'm kind of just saying there's something more than them just being idiots. Maybe there's something they saw in the last year sitting at home that changed their outlook. And we need to understand they've got a different outlook about things, and as opposed to the way that we used to think about the world in 2019.
All right. Well, I think this is a really important insight that you brought here, which is just that, the consumer mindset has changed. It's been imprinted by what we just went through with COVID, the same way that society was going through the Great Depression. And I think the answer is we don't know yet exactly how and what the ramifications are going to be. So I think it is important, you are right, which is that the mindset has changed. My worry here, it sounds like I share it, is just looking at the current behavior that we're looking at right now, which is the willingness to spend when the future income stream looks so uncertain, especially in a rising cost environment. It just feels reckless to guys like you and I who are watching from the sidelines here. And I certainly hope it doesn't end as badly as I fear it could, which is sort of the genesis of my question here in general. But who knows?
Can I just say, I share your concern too. And maybe part of that was, go back to the spring of 2020. Everybody had the hell scared out of them. This is it. This is going to be worse than the Great Depression. We're going to have soup lines. We're going to have bread lines. It's going to be as bad as youth can possibly imagine. And then the helicopters came. They threw money out the window.
The markets were all-time highs within a couple of months. Yeah.
Right. So, hey, aren't you worried that you're going to run out of money? No, I went through the spring of 2020. Don't worry. At some point, the helicopters will be back here throwing money out the window or something like that. And maybe it's going to have to take, if you want to get everybody's mindset back to some pre-2019, is things are going to have to get bad. There ain't going to be no stimulus. It's going to get worse. There's going to be no stimulus. It's going to get catastrophic. There's going to be no stimulus. Oh, okay. Now maybe I better start rethinking this. But boy, that we're going to have to go through a lot of pain before we get there, because I think there might be an assumption that, when it gets bad enough, kind of like what the financial markets are, right? Why do people keep buying corporate bonds at these levels, or high yield at 3% yields? Because the Fed will buy them if it gets bad. Well, the Fed stopped buying. Well, don't worry. Give me 3 bad days in the markets and the Fed will crank up the printing press. The public's got the same idea, right? When it gets bad enough, they'll start putting money back in my checking account. So just hang out. Don't worry. It will come as well.
This is the subject for a whole other 3-hour long interview with you, Jim.
Yeah.
But it really all does come back to the Fed, at least in my mind. Intervention leads to distortion. Distortion then ruins true price discovery, and people begin making decisions based upon the distorted prices, which are not reality. And at some point, reality always comes back to bear. And when it does, it just destroys the people who were, living in the fantasy life that the distortions all created. So anyways, we could go into that forever. I want to try, I've got a ton of questions I'm not going to get to here, but real quick, as we leave the Fed, there is one important thing. So another way in which we were talking about how, the mindset is changing. It's interesting. Maybe the mindset might be changing towards the Fed. And we're in the very early days of this, but the Fed really got caught with its pants down recently, where a couple of high-ranking Fed executives were found out to have been trading all last year, million dollar trades many times, that benefited from the policies that these guys were voting for, right? And I think the public finally woke up and said, wow, that actually doesn't seem fair at all. The guys that are writing the rules are kind of front running all this. I'd go to jail if I did this, but they're not, right? I didn't see the conference. Was Powell, anybody probe him about that at all?
Oh yeah, they probed him quite a bit about it. They even probed him about his own positions because, he owned a bunch of municipal bonds, and he said that, he literally said, I own municipal bonds because I thought that they were outside the scope of what the Fed was going to do. But then 2020 came and we started buying muni bonds, and, he didn't say it, but he was implying that my muni bond portfolio went up quite a bit as well too. But yes, they were probed about it, and they gave the typical bureaucratic answer, right? The general counsel looked at it and they said that no rules were violated. Everything was okay. But we're going to change the rules so it never happens again. It's basically the way that they're going to deal with it. No, it is problematic, especially when you get to Bob Kaplan, who's the Dallas Fed president, Federal Reserve president of Dallas. He was day trading S&P futures all throughout the whole pandemic crisis and the decline down. He was literally, yes, he was day trading S&P futures, and also bought a big chunk of the Kansas City Royals baseball team at the same time as well too. He's a former Goldman Sachs managing director, so he's got a lot of money and stuff like that. But I cannot believe he did that. And I cannot believe that the general counsel of the Dallas Fed said, okay, no problem here, nothing to see as well, and signed off on that as well. So, yeah, no, I think they've got a real problem on their hands because, central banks operate on credibility, and they've got an enormous responsibility with their fingers on financial markets. And if they're starting to play around with this, and then you've got Eric Rosengren in the Boston Fed who was buying REITs, and they were basically buying mortgages, and the mortgages that the Fed was buying were directly benefiting the REITs that he was buying as well too. So they've got an issue on their hands because they've broadened the scope of the Fed interventions in the market so much now. There's almost nothing that a Federal Reserve official can invest in that doesn't fall into their reach. I mean, there's ways they get around it, but look, they've made, this is a bet they made for themselves, and they're going to have to deal with it.
Yeah, well, it's going to be interesting here because I'm sure you've heard all the people use the analogies of, the Fed is the arsonist that started the fire, but they're being cheered as the firemen who are coming to the rescue and whatnot, right? And I think in this story, a lot of the real fundamental issues that we rail about, overpriced assets, dangerously overpriced assets, accelerating wealth equality and whatnot, you really can trace back to Fed policy is really at the heart of a lot of these things. But the Fed is still being treated as the hero in the story. And this may be one of the very first developments that is maybe putting some cracks in that trust and that faith, and maybe opening more critical dialogue going forward about what the limits should be on what the Fed is doing. So
I'll just say I absolutely agree with you that the Federal Reserve, I've quipped a couple of times that the Federal Reserve is a perfectly created wealth inequality machine, that they basically help the wealthy at the expense of the poor. And I'll go you one step further. I think, yes, cryptocurrencies, the problem with them is that, you've got insane speculation in one pond, but on the other hand, they're trying to create a new financial system as well too. And what does that create a new financial system about? The inherent inequality in the current financial system. It is so obvious and so painful for a lot of people how unfair the system is, that seems to be what they're trying to exploit with cryptocurrencies as well. And who's the leading charge of this is the Federal Reserve itself, and in the way that, the system benefits the wealthy against the people that are unbanked or underbanked as well too. They're just at such a disadvantage to everybody else.
Absolutely. I sing from the exact same song sheet as you there, Jim. So real quick, transitioning to cryptos, another development, I could see you and I were sort of tracking it in real time on Twitter as he was announcing it, but SEC Chair Gary Gensler, basically just came out with pretty declarative statements that the SEC is going to be taking much tighter control, or having much lower tolerance level for kind of the Wild West nature of the cryptocurrency universe, and going to be regulating it much more, looking at taxes much harder. It basically just sort of sounded like, all right, guys, the sheriff's in town now. We're going to clean things up here. You've had a fun ride, but don't expect it to be fun going forward, or at least as fun. You followed this much more closely than I. What were your takeaways from that? And speak for a second too about how I think the crypto world was pretty excited that Gensler was coming in, because he had taught a class at MIT in his previous life about the cryptocurrencies, and thought he might be more favorable. But there's a little bit of a sense of betrayal at this point, I sense.
Yeah. You're right. He was at the CFTC. He was at MIT. He taught a class on blockchain. He taught a class on decentralized finance. The cryptocurrency world was excited because, in their words, he gets it. And at least when he was at MIT, he seemed to get it. Then he gets to Washington. And one of the things I've learned about Washington is you get a position of power like you're the chairman of the SEC. Well, you get to sit in a room, with the Federal Reserve chairman, with the Treasury secretary, maybe with the president, and you guys get to formulate policy. You get to speak your mind. Hey, this is what I think the policy should be, and everybody will take you seriously. But at the end of the day, they, and they is maybe Janet Yellen, will tell you, here's what we've decided. Now your job as the head of the SEC is to, in the words I used, is to prostitute your reputation in your office, and you go out and you sell this. Even though it might not be what you want, you signed up for this job. We heard you out about what you think we should do. Now you go sell this. And if you can't sell this, you can go back to MIT and somebody else can sell it. So he's out there pushing really hard. He came out and said he doesn't think that cryptocurrencies are going to last over the long term, that he thinks that they're going to flame out and go away. You were teaching freaking classes at MIT about this stuff 2 years ago. Now you're telling us that all those classes you were teaching those kids were about was stuff that was going to disappear in 3 years. So yeah, there is a real sense of betrayal by Gensler, but this is the nature of being a bureaucrat in Washington, and they are going to push really hard. And when you really peel back and you hear what they're trying to say, they keep saying investor protection, but it really sounds more like incumbent protection is really what they're more afraid about. They're more afraid about what it means for the banking system, what it means for the regulators, as well, to not necessarily what it means for the public. Yes, cryptocurrencies are the Wild West. And yes, there is some fraud and there's some rank out of control, irresponsible speculation. And yes, something should be done about that. But the answer is not destroy the whole system because some coins are moving too fast for your liking as well. So it just seems like they're trying to do incumbent protection is what they're doing. And the last thought for you, if you look at, there's a company called Chain Analysis that looks at where cryptocurrencies are owned. In the top 20 countries, there's only one developed country in the top 20. The United States ranked number 9. Vietnam ranks number 1 as the biggest penetration of cryptocurrencies. If the SEC thinks we're going to put rules on Americans and benefit the US banks to prevent Americans from holding cryptocurrencies, when you've got the rest of the world jumping headlong in this, why the rest of the world? Because they're unbanked, they're underbanked. The financial system has been inherently unfair to them. They see cryptocurrencies, they see decentralized finance as something that could benefit them, like Panama accepting Bitcoin as one of their currencies as well too. They can't stop it. They can make it messy in the middle, but they cannot stop it. And they're going to have to wake up like mayors did when it came to Uber. They couldn't stop it. I know the taxi cab companies were screaming at the mayors, do something about these Uber guys. You can't allow them. We paid all this money for these taxi medallions. At the end of the day, they couldn't really stop them. And I think that they're going to have to realize that the same thing is going to happen with decentralized finance.
Yeah, it's the whole genie out of the bottle scenario. So again, yet another full hour interview I could do with you on just that topic, Jim. I'm going to keep you busy for the next couple of months, it sounds like.
Yeah.
But I think your main point there too, which is the interpretation of what's happening here is it's sort of the Empire Strikes Back, right? It is the reassertion of top-down control, which we're seeing in all sorts of different parts of the economy and society right now. So, all right, I'm going to do the highly unfair task of asking you to be just give your blunt, quick answers on some questions that I and our viewers would love to hear you expound on.
Lightning round.
More time. Yeah. So how concerned are you of a major correction or crash risk, given the record high valuations that most asset prices are trading at now, and B, all those deflationary elements that we talked about potentially happening next year, the various fiscal monetary cliffs, et cetera. Do you think it's a high risk? Is it something that keeps you up at night or not?
Not yet. I'll answer quickly. Over the next 3-ish months to the end of the year, not too worried about it. By the end of 2022, yes. I think that there might be a very stiff correction coming down the line. I just not so sure it's ready to come right now. There's way too much pessimism in the marketplace for me to think that this is going to be the start of it.
Okay. And for the prudent investor who wants to position themselves smartly between now and then, what favorite asset classes are you most sanguine on right now? I'm a simple guy when it comes to that kind of stuff. I own those same ETFs that everybody else owns, and I'm not going to try and get cute and give you a sector or something like that.
As long as I think that the market is going to continue its uptrend, as long as I think that every day people are going to continue to throw money in the market, at least through the end of the year, I think they are going to do that, I'm going to play. When I think that something is going to change that's going to cause that, upset that, then I'll get out. And what that could be is much higher interest rates. If I was to see much lower interest rates too. But as long as interest rates continue trending in their range like they have for the last few months, I think the game continues.
Okay, game continues until we start breaking through the outlying edges of the current interest rate range. All right, great. Last question, just investment related. I know that you are a fan of crypto, recommend that people have some exposure to crypto. Are there any other sort of alternate assets, hard assets, et cetera, that you think make sense in a portfolio now? Meaning not for a potential crash or whatnot, but just for another year or so of status quo that you see.
Yeah, I mean, I've pushed the idea that people should understand crypto and they should definitely get their head into it, because I don't think it's going to go away. Now, as far as other alternative assets, the problem is there's nothing that's cheap in this world, right? Real estate, that's definitely not cheap. Don't want to touch office real estate if nobody wants to go back to the office as well too. So I'll come back to the basic one that seems to work time and again, and it's precious metals. And maybe a little bit of commodities as well too. Though my problem with commodities is they're a little hard to own with roll and futures and all that other stuff. But precious metals, I think, would probably be a good store of value over the long term. They have, and I think that they will continue to be.
All right, great. And with that, Jim, I just thank you so much for packing so much into this interview. Again, I look forward to having you on again in the future. But for folks that have watched and really enjoyed your insights, if they'd like to follow you and your work, where can they go?
Twitter is probably the best place, at Bianco Research. You can follow me on LinkedIn. You can check out our website, biancoresearch.com.
Great. I'll put those URLs up on the screen when we do the editing for this. I'll let you go here, Jim, but thank you so much and so great to see you.
Thank you.
All right. And Mike Preston, folks, this is the time in the interview every week where I talk to the financial advisory firm that's endorsed by Wealthion to find out what the markets have done over the past week. I'm joined here this week by Mike Preston. His co-partner, John Lodra, is off for the week. Mike, but what a phenomenal interview with Jim Bianco. I'm curious to hear your reactions.
Thanks, Adam, and yeah, I really enjoyed Jim's just fact filled